To start off, several facets of banking are impacted by the risky capital structure of commercial banking, which consists of using demandable debt to finance output and participate in the payment system of the economy. An intensive analysis of a bank's probability, liquidity, and risk management tactics is necessary to evaluate its success. Return on equity (ROE) and return on asset (ROA), two measures of bank probability, are important indicators of how well the institution uses its resources to turn a profit. Liquidity highlights a bank's ability to satisfy short-term financial obligations without suffering large losses. Sufficient liquidity preserves depositor confidence and guards against shortage. Important liquidity measures that show how well the bank can manage its cash flow and are the loan-to-deposit ratio and the cash reserve ratio.
Maybank Islamic Berhad, the Islamic banking arm of the Maybank Group, is a leading provider of Islamic financial products in the Asian region. Established in 1993 and becoming a full-fledged subsidiary in 2008, with a significant market share of 26.2% in financing and 23.2% in deposit as of 2012 and total asset of 91.4 billion, Maybank Islamic is a key player in the global Islamic finance. It operates over 354 touchpoints in Malaysia and international hubs, offering a wide range of Sharia-compliant products. As a subsidiary of Maybank, a leading banking institution in the Southeast Asia, Maybank Islamic benefits from its parent company extensive network and expertise. Maybank Global presents spans all 10 Asian nations and key financial centers worldwide. Recognized as the Malaysia's most valuable bank brand in 2020, Maybank is included in prestigious rankings like the Banker Top 1000 World Banking and Forbes Global 2000 Leading Companies. Within this framework, Maybank Islamic advanced the Islamic banking agenda and supports Maybank Group strategic goals.
Okay, now I would like to present about profitability analysis. Profitability analysis has a 5 ratio, which is return on asset, return on equity, return on deposit, profit margin, and profit expenses ratio. Return on asset or ROA is a financial indicator to calculated by using the formula net income divided by the total asset. This metric provides insight into the ability companies to generate the profit from its asset.
The ROA showed a positive trend from 2014 to 2018, reflecting improved asset utilization efficiency and profitability. However, in 2019, ROA remained relatively stable, decreasing slightly from 3.35% in 2018 to 3.30%. In 2020, ROA saw a further decline from 3.30% to 3.03%, indicating a potential drop in profitability or efficiency in asset utilization. In 2021, ROA rebounded slightly, increasing to 3.10%. This level remained unchanged through 2022. Yet, in 2023, ROA experienced a slight decrease, dropping to 2.91%, suggesting another potential decline in profitability or efficiency in asset utilization. Overall, while the ROA ratio fluctuated over the years, there was a general upward trend from 2014 to 2018, followed by a slight decrease in the subsequent years.
Second is return on equity or ROE is a key financial metric. The formula of ROE is a net income divided by the total equity capital. This metric provides insight into how effectively a business uses shareholder equity to generate profit.
Ratio ROE stayed high from 2014 to 2016, showing efficient use of equity for profit. There was slight decline in 2017 and 2018, with a more notable drop to 21.84% in 2019, indicating potential challenge. In 2020, ROE fell further to 20%, suggesting significant profitability issues. It improved slightly to 20.78% in 2021 and increased to 22.18% in 2022, hinting at a strategic turnaround. However, in 2023, ROE decreased again to 21.21%, highlighting ongoing profitability challenge.
Third is return on deposit or ROD is a crucial financial metric for banks. The formula for ROD is the net income divided by the total deposit. This metric quantifies the profit or profitability generated from the deposit fund over a specific time period, typically expressed as a percentage.
Ratio of ROD from 2014 to 2016 increased modestly, indicating improved profitability on deposit funds. ROD remained stable at 3.93% in 2017, then surged to 4.96% in 2018, signaling remarkable returns. However, there was a slight decline to 5.08% in 2020. From 2021 to 2023, ROD gradually declined, suggesting challenge in maintaining high returns on deposits.
Next is profit margin. Profit margin is calculated using the formula net income divided by revenue then multiplied by 100. This financial indicator shows the profitability of an operation as a percentage of sales.
For ratio profit margin, stay high from 2014 to 2018, showing efficient cost management and strong revenue. It slightly decreased in 2019 but rose to 59.32% in 2020, reflecting recovery. However, it slightly dropped to 60.91% in 2022, suggesting challenge is sustaining high profitability. The drastic fall to 48.55% in 2023 highlights significant challenge impacting profitability, urging a closer examination of underlying causes.
And lastly is the profit expenses ratio. The profit expenses ratio is a financial metric calculated using the formula profit divided by the total expense multiplied by 100. This ratio compares a company profit to its expenses, providing valuable insight into cost efficiency.
For the ratio, in 2014, it was a 68.72%, indicating efficient cost management and profitability. From 2015 to 2017, the ratio declined, suggesting a challenge. However, in 2018, it significantly increased to 64.19%, reflecting improvement. In 2020, it dropped to 60.19%, signaling continued challenge. But 2021 showed a notable increase, indicating significant improvement. Yet, in 2022, it sharply decreased to 67.02%, suggesting difficulties in sustaining high profitability. By 2023, the ratio notably dropped to 46.94%, indicating increased challenge or inefficiencies. Fluctuations over the years highlight the need to investigate underlying factors for an accurate assessment of the company's financial health.
Next, I'm Natasha will continue this presentation about other financial analysis that focusing on liquidity indicator. This liquidity indicator is a very crucial in bank operation because it measures the bank's ability to meet its short-term obligation without running into financial trouble. In short, it tells us how easily a bank can convert its assets into cash to pay off debts or fulfill customer withdrawals. A bank with strong liquidity indicator is seen as stable and reliable, ensuring customers feel confident their money is safe and accessible when needed. On the other hand, poor liquidity may indicate the possible problems and may end up in loss of confidence and a bank run in which several customers withdraw their money at once. So, a bank's proper operation and general financial health need to monitor and maintain appropriate levels of liquidity. There has many of these indicators, but for this project, I would like to share only 4 of it, which is current ratio, loan deposit ratio, cash deposit ratio, and lastly the cash ratio. Let's delve into deeper together. First thing first, current ratio. What is current ratio? Current ratio is an indicator that measures a company's ability to pay off its short-term liabilities with its short-term asset. It can be calculated by dividing the current asset with its current liabilities, and for this Maybank Islamic Berhad, it shows some fluctuation from year 2014 to year 2023.
If we look at this graph, we'll see that during the year 2014 until 2018, the current ratio remained relatively low and showed minor fluctuations. A current ratio below 1 usually indicates that the company may have trouble covering its short-term obligation with its short-term asset. However, it is common in the banking industry due to the nature of banking operation, where banks often operate with high levels of deposits and loans. Next, the graph shows a general output trend peaking in 2022 at 0.2842 before slightly declining to 0.2465 in 2023. The increase over these years give an improvement in the bank's liquidity positions, meaning it has been better able to cover its short-term liability with its short-term assets.
The loan deposit ratio (LDR) is measured to help us understand how well bank is managing the money it's lent out compared to the money it has in deposit. It can be calculated by dividing the loans with its deposit. This bank has shown some notable fluctuation over the years.
In the year from 2014 to 2017, the LDR remained around 2%, indicating that the bank was lending out almost twice as much as it had in deposits. This suggests a strong confidence in its lending operation and a high demand for loans. However, starting in 2018, there was a sharp decline in the LDR, dropping to 1.64% and further decreasing each year until 2021, when it hit as low as 0.53%. This dramatic drop could indicate several factors, such as a strategic shift by the bank to reduce lending risk, a decrease in loan demand, or a significant increase in customer deposits without a proportional increase in lending. From 2020 to 2021, the LDR was particularly low, possibly reflecting the impact of the COVID-19 pandemic. During this period, many banks saw reduced lending activity due to economic uncertainty and a rise in savings as people became more cautious with their finance. By 2022 and 2023, the LDR began to recover, rising to 0.8% and then 1.31% respectively. This recovery could be due to an economic rebound, increased consumer confidence, and a gradual return to more normal lending and borrowing behavior. These ups and downs in the LDR are a natural part of banking operation, influenced by broader economic conditions, changes in customer behavior, and strategic decisions by the bank to balance its risk and growth objectives.
Next is the cash deposit ratio (CDR) that is the measure of how much cash the bank holds relative to its total deposit. It can be calculated by dividing cash with its deposit. A higher CDR shows that the bank is keeping a larger portion of its deposit as cash, which means it is more liquid and more easily meet withdrawal demands. However, a lower CDR means the bank has a smaller proportion of cash relative to its deposit, which might imply more funds are tied up in other assets.
If you look here, we can see a chart pattern of ups and downs in the CDR over the years. Initially, the CDR increased from 2014 to 2015, indicating that the bank was holding more cash relative to its deposits. This could have been due to a strategic decision to enhance liquidity, perhaps in response to economic conditions or regulatory requirements. However, after 2015, the CDR generally declined with some fluctuation. Ratio continually declined to 0.0838 by 2017 and remained unstable in the following years. The large drop to 0.0647 in 2019 may indicate that the bank felt secure enough in its liquidity management to increase investments in other assets and increase profits. The slight rise in 2020 to 0.0847 could be due to the need for higher liquidity during the COVID-19 pandemic, where banks generally increased their cash reserve to cope with uncertainties. Post-2020, the CDR saw another decline, reaching as low as 0.0561 in 2023. This might indicate a strategic move towards using more deposits for other investments or loans, suggesting a focus on optimizing returns rather than holding excessive cash. The ups and downs in the CDR reflect the bank's balancing act between maintaining sufficient liquidity to meet customer needs and maximizing the use of deposits to generate income. External factors like economic condition, regulatory changes, and market opportunities also play significant roles in influencing this strategic decision.
The cash ratio for Maybank Islamic Berhad over the years has shown major fluctuation, expressing the bank's different level of quick liquidity. This ratio measures the proportion of a bank asset held in cash and cash equivalents compared to its current liabilities. In short, it implies how well the bank can meet its short-term obligation using its most liquid asset.
This stat shows how much cash the bank has relative to its short-term obligation. Over this period, we see fluctuation in the cash ratio. It peaked in 2015 at 0.1054 and then generally declined, reaching its lowest point in 2023 at 0.0438. The fluctuation in the cash ratio can be attributed to various factors. A higher cash ratio in some years might indicate the bank was maintaining a larger cash reserve to ensure liquidity, perhaps due to economic uncertainties or regulatory requirements. For example, the peak in 2015 could have been influenced by a conservative approach to risk management following the financial uncertainties in the previous year. In contrast, a lower cash ratio could signify that the bank was using its cash reserve for other purposes, such as expanding its lending activities, investing in growth opportunities, or optimizing its asset allocation for better returns. The decline from 2016 onwards, and particularly the low in 2023, might suggest that the bank found more efficient ways to manage its liquid asset or face increased current liabilities. Economic condition, change in the banking sector, or specific strategic decision by the bank management could also influence this variation. In final, while the cash ratio provides insight into the bank's liquidity, it must be considered alongside other financial indicators and the broader economic context to understand the full pictures of Maybank Islamic Berhad financial health and strategy.
I will start with risk and solvency ratio. At first, I will talk about debt equity ratio. Debt equity ratio is a financial indicator that provides a comparison of company debts and equity to analyze its capital structure. I have some analysis for this ratio from 2014 until 2023. First, since 2014, this chart shows a decrease in the low scale and a return to the upward climb in 2020. Starting with the highest ratio, 10.74 times, this indicates that for every unit of equity, the corporation has financed roughly 10.74 units of debt. A high ratio like this suggests a heavy reliance on debt financing, which raises the company financial risk but may also increase returns on equity. Next, I will explain debt to total asset ratio. Debt to total asset ratio is a financial in finance used to evaluate how much of an organization asset or financed by debt. From the analysis, this ratio is from 2014 to 2023. This ratio, which calculates the percentage of an organization asset financed by debt, is a basic financial indicator used to evaluate company leverage and risk exposure. The debt and total asset ratio shows variations during the 10 years period, ranging from 15.53% to 33.88%. That is equity multiplier ratio. This for evaluate the degree to which an organization is dependent on debt for the financing of its asset. Multiplier ratio is shown in the data set per year, spanning from 2014 to 2023. A finance indicator called the equity multiplier ratio shows how much of a company assets are financed by equity as opposed to debt. The equity multiplier ratio in this dataset vary from 1.911 to 2.471. The equity multiplier ratio variation during the 10-year period point to changes in the financing and the capital structure choices made by the company. For example, the ratio of 2.083 in 2014 started to slightly decline to 1.993 in 2016, which is good signal to move toward more conservative financing method or greater reliance on equity financing. Last one is loan to deposit ratio. Loan to deposit ratio assesses the flexibility of a bank in the event that the proportion falls below 100%. That bank has more cash on hand because it has more deposit than loans. This ratio gives an indication of a bank capacity to satisfy loan demand and client withdrawal requests by comparing the percentage of loan it has made to total deposit. Beginning with the lowest ratio of 75.70%, this suggests that the bank is lending conservatively, keeping the sizable percentage of its deposit in highly liquid asset as opposed to making loans. Although the strategy improves liquidity and protects against future liquidity crises, it can also make it more difficult for the bank to maximize profitability and earn interest from lending operation. The dataset trends analysis shows that the loan from 75.70 to 73.30%, suggesting a possible move toward more aggressive lending practices or modification to the market that impact loan demand and deposit growth.
Out of all probability analysis, profit-expense ratio shows an unstable condition of increase and decrease until the year of 2021, where it reached the highest ratio, which is 86.07%. After that, the ratio decreases sharply to 67.02% in the next year and drops even more in 2033, turning into 46.94%. It shows a decrease of 39.13% within 3 years of operation. The bank's declining profit expense ratio usually indicates a decline in profitability in relation to operational costs. There are several things that could be causing this drop, which are operating costs without a commensurate increase in revenue could be the main cause. A strategic approach that prioritizes streamlining operation, controlling costs, and increasing revenue streams is necessary to address a decline in bank's profit expense ratio. Moving on to the liquidity indicator, cash ratio shows that from the year 2015 until 2019, the bank faced a decrease in ratio while also earning a little increase by 0.001% in the year of 2018. From the year 2019 until 2022, the bank faced slightly increase in ratio but decreased back in the year 2023. Thus, the bank experienced 3 times decrease in ratio within 10 years. A possible explanation for the decline in cash ratio could be that the bank cash reserves are being depleted by an increase in customer withdrawals or loan disbursements without matching inflows, diversifying funding sources and strengthening liquidity buffers in order to manage a decline in bank's cash ratio. Next is risk and solvency ratio, where debt to equity ratio shows that from the year 2014 until 2020, the bank experienced a decrease in debt to equity ratio, which is phased for 6 years within the total of 10 years recorded. Then, the ratio increased slightly each year from 2021 until 2023. A rise in the bank's equity capital in comparison to its debt commitments could be one of the factors contributing to a decline in the debt to equity ratio. Initiatives like stock issuing for equity financing and gradual accumulation of retained earnings may be the cause of this. Bank can assess how much capital it needs and think about obtaining more equity funding through several channels such as right issues, private placement, and public offerings. To conclude, the comprehensive assessment of bank performance based on probability, liquidity, and risk management aspects is essential for interest parties who want a detailed picture of a bank's operational and financial stability. All-encompassing analysis of a bank's profitability, liquidity, and risk management tactics is required for a thorough review of the institution's performance. Stakeholders can obtain a true picture of the bank's long-term viability, operational effectiveness, and financial health by taking into account these economic characteristics. In a financial environment that is constantly changing, this all-encompassing strategy empowers stakeholders to make a well-informed decisions, reduce uncertainty, and seize opportunities. That's all from us. We appreciate your time and attention given throughout this video. Thank you.